Real estate financing. A promissory note is an evidence of a debt. It's an IOU. And at closing, you're going to pay documentary stamps on any new promissory notes that are created. The mortgage, on the other hand, is a pledge of security. And all you're saying is that if I don't repay the debt according to the promissory note, that you can take the property and sell it at a public auction. So the mortgage is collateral, and you're going to take the mortgage and have it signed with two witnesses, have it notarized, and have it recorded on public record. Remember, you do not record the promissory note. In fact, you don't even witness the promissory note. But the mortgage does have to be witnessed, and it does have to be recorded on public record. There are a number of terms in the mortgage that you need to be aware of. The defeasance clause simply defeats the purpose of the mortgage. In other words, what it basically says is that as soon as the debt is repaid in full, that the lender has to provide a satisfaction of mortgage, saying that the property is no longer collateral. The prepayment clause in the mortgage is simply a clause that outlines the lender's rights to collect a penalty in the event the loan is paid early. Now, if the prepayment clause is silent about penalties, the borrower does have the right to prepay some or all of the loan balance without a penalty. The exculpatory clause is a clause in a mortgage which simply says that if the borrower defaults, the lender can only look to the property for satisfaction of the debt. In other words, there can't be a deficiency judgment with the exculpatory clause. The acceleration clause simply is a clause that says that if the borrower defaults in any way, that the lender can accelerate the debt, call the entire debt due and payable. Remember that you cannot foreclose on something that's not delinquent. So in order to make the entire loan delinquent, the whole loan is accelerated. The mortgage legal theories. Florida is a lien theory state, which simply means that when you borrow money from a bank, the borrower retains legal title. Remember that the borrower is the mortgagor. They retain legal title, make payments. When the loan is paid out, the bank gives them a satisfaction of mortgage. There are some states that are still title theory. When you borrow money from a bank, you simply deliver the title to the bank during the period of payback time. Some states are considered to be title theory, and all that means is that at closing, you turn the title over to the bank until the loan is repaid. Amortization. There's the fully amortized loan where you're making equal payments, which are principal and interest, and at the end of the term, the entire debt is retired, is paid in full. Now remember, the earlier stages of a loan, you're paying a lot more interest than principal. In the partially amortized loan, you're making payments, but at the end of the term, you've not made enough payments to pay out the loan, so that last payment that you make is going to be exceptionally larger than the others. It's called a balloon payment. Discount points are prepaid interest, and the borrower will pay those at closing. And basically, what the borrower is doing is buying down the interest rate. And the way that it's calculated, for every point that a lender charges a borrower, it will cost the borrower 1% of the loan amount. As far as the yield to the lender, for every point that a lender charges, it increases their yield by 1/8 of 1%. Other types of mortgages that we deal with, a package mortgage is both real and personal property. A blanket mortgage covers more than one parcel of real estate, and it's going to require a release clause to sell off smaller portions or smaller lots out of the blanket. The purchase money mortgage is typically considered seller financing. Term mortgage is interest only. A good example of that might be a construction loan. And typically with a construction loan, there has to be a takeout loan to go along with that as well. In any assumption, the lender is going to require the new borrower, who's the buyer, to sign a promissory note. And the way they look at it is, if you're going to take title, we want you to also be liable for the debt. Also remember that the previous owner is still going to be on a note somewhere. In other words, they'll still be responsible as well. And the only way that that previous owner can be released of liability is through a process known as novation. Novation is a release of liability. The types of mortgages, we have an FHA, which is an insurance premium. The FHA, you pay your insurance twice, one up front, and then monthly with your mortgage payment. The qualifying ratios, the housing expense ratio is 31% of the monthly gross income, and your total obligation ratio is 43% of your monthly gross income. VA is a partial guarantee. And what you need to know the difference of the two, the FHA and VA. FHA, there are loan limits. VA, there are no loan limits. But remember, as far as the VA is concerned, you can get a loan for up to $417,000 with nothing down. Any loan amount above $417,000, the borrower is going to be required to bring 25% equity to the closing. Also, as far as qualifying ratios, the VA only uses the total obligation ratio, and theirs is 41% of the monthly gross income. Conventional loans use private mortgage insurance, and what that does, it covers any of the loan amount that's above the 80% loan to value. Also, the qualifying ratios for conventional are considerably more conservative. It's 28% for the housing expense ratio, and the housing expense ratio, remember, is your principal, interest, tax, and insurance. Your total obligation ratio is 36% for your conventional loans. The various sources of funds, you have savings associations, which is an intermediary, you have commercial banks, and you have life insurance companies. And let me say this about life insurance companies. They are the largest lender of your large-scale commercial properties. The reason for that is that they have a lot of money in their treasury. They've got unlimited funds almost. Plus, they're only regulated in the states that they do business. They are not federally regulated. We also have mortgage bankers who can make loans and approve loans. And then we have mortgage brokers. Remember that a mortgage broker is simply a company that brings borrowers and lenders together for a fee. They can't make loans and they don't approve loans. In the secondary mortgage market, we have three different areas. And the secondary mortgage market, first of all, doesn't make loans. It's where mortgages are bought and sold, however. The Federal National Mortgage Association, better known as Fannie Mae, was created in 1938 to purchase the FHA insured loan. Today, Fannie Mae insures all the loans, the FHA, VA, and conventional. They are right now privately owned to some degree, and they're traded through the New York Stock Exchange. The Government National Mortgage Association, known as Ginnie Mae, is a government agency. And what Ginnie Mae does, it acts as a subsidy program. In other words, anytime that there are low-yield loans made to deserving families, Ginnie Mae will step in and make up the difference. They work hand in hand with Fannie Mae in a program known as the Tandem Plan to be able to provide low-yield loans. The Federal Home Loan Mortgage Corporation, also known as Freddie Mac, was created to purchase conventional mortgages from savings and loans. Today, Freddie Mac buys all three as well, just like Fannie Mae does, the FHA, VA, and conventional loans. Foreclosure is a process that the bank has that if you default on your promissory note. And remember that the first step in the foreclosure process is filing a lis pendens. Once the foreclosure process begins, the property owner has a period of time to redeem themselves of that default. That period is known as the equity of redemption. Now, what they've got to do, since the entire note has been accelerated and called due and payable, they've got to come up with all the money. But they have up until the public auction for that equity of redemption or to redeem themselves. Once the public auction occurs, and once it's sold, if there is a deficiency, in other words, if there's not enough money at the public auction to pay for the outstanding loan balance, that deficiency is going to turn into a judgment and be placed against the homeowner until it's paid off. If there happens to be any money that's left over from the public auction, it will go to the property owner themselves. It does not go to the bank.